Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody, and thanks very much for tuning into the show. I'm Jeff Barton, and this is The Mortgage Voice with Jeff Barton, which you can see here every week on a number of different stations. We have been on the air now for, how long have we been on the air, Daryl? 7 years?
This is show number 249 of the video.
Okay.
This for about 5 years.
Okay, 5 years of you, I think a couple of years right before that. So as the 7 years rolls around, we have been on one heck of a sleigh ride with the mortgage, everything to do with mortgages. If you're a consumer out there, somebody that's bought a house several years ago, you're not really aware of it. If you're looking for a house today and you're trying to get out there and get the best deal you can, you're not really aware. But let me just tell you, since the crash of 2008, when Dodd-Frank rolled in and all the regulations rolled in, and a lot of new companies came to the marketplace in order to help people to try to get a loan. We've seen rates everywhere from 6.5 all the way down to really 2.25. We are now seeing a rise again in rates, and that came about today or this week, and probably is a trend that will continue. Now what do we mean by that? Okay, we were at 2.25, 2.5% on a 30-year fixed for long time, right? And we saw historically low rates last month. I mean, we were setting records on it. Well, now we're seeing the opposite happen. We're seeing rates climb. So we go from 2.5% to almost 3% on a 30-year fixed. And is that a good thing? Is it a bad thing? What happens when that happens? What happens to the dollar that you're trying to stretch as far as you can to get into a house that really you don't think is worth it, but because we've had real estate prices really rise by 10% or more in most markets in Southern California, in Albuquerque, New Mexico, in Las Vegas, Nevada, in Central California, up in the Tahoe area, all the stations and places where we reach. Now, if you are a YouTube watcher of the show, you can also look at where you're living and say, you know what, it's done that here too. And that is going to continue. The reasons why we've covered many times, there's not enough houses. That's why prices go up. But as rates go up, fewer and fewer people are able to purchase. If rates go up 0.25%, 1 million less people can afford to buy. That's what kind of market we're in. But if you talk to realtors, and we will talk to realtors throughout the month, throughout the year, and they will tell us what's happening in their market real estate wise, that there's not enough inventory, that in order to get the property, they're in there with 5 or 6 different people competing. They have to have the most and the strongest mortgage pre-approval letter possible. Now, we're about ready to embark here on the show to some education videos, the how to fill out a mortgage application, how to get the best credit, how to, make sure that what you're doing is the best for you and that you understand it. We're going to do it in multiple languages. And the reason is because you need help out there as consumers. It is not on the mortgage broker. It is not on the real estate broker. Unfortunately, the market conditions, the way they are going to dictate what we do. Forearmed is forewarned, or forewarned is forearmed. And for you as the consumer, and you're out there and you're listening, you're going, oh, great, another thing I have to do in order to get into the real estate market. It's the best way that you're going to be able to pass multi-generational wealth from you to your kids, from your kids to their kids, is your home. Most people in the United States, 50% of the people in the United States own outright. Most people in the United States own a home. 75% of white people own a home. Only 40%, 45% of African Americans own a home. These things are what we call wealth disparity. And when we talk about wealth disparity, income redistribution, all the stuff that people hate as socialist ideas, what we're really talking about is, can you afford a home, and how are we going to get you into a home? So it's about making sure that you're educated. So these educational videos we're going to roll out, and we're going to try to help you educate yourself so that you're better prepared when that house comes along that you can afford. But unfortunately, we're in a rising rate climate. a rising rate climate is not a good thing for you. It's not a good thing for the marketplace. However, is it a good thing for the economy? Is it a good thing for the country? Okay, so when we talk about rising rates, what we usually point to is what? It's the 10-year bond, right? We always say, okay, follow that 10-year bond. So you've been diligently every day going online. Okay, here's the 10-year bond. What is it today? And what is it tomorrow? And a year ago, it was about 0.53. That's when we started really watching it. About a year ago, 0.53. What does that mean? That means when you buy a bond, and they sell those bonds in 100 bond increments. So whenever you see a price quoted from the bond market, you know that it's based on buying 100. Now, why do they say that? Because the math's easier with 100 rather than 74. So if on a bond, you're expecting to purchase that bond, the bond on a 10-year note, that means for 10 years, you will get a yield of X based on Y that you pay for the bond today. So if you pay $102 per bond times 100, that's what you're going to pay for the 100 bonds, right? But you will receive a yield based on that. Now, two things. Cost of the bond and the yield mean what to the mortgage rate? So if your yield has to go up because you're trying to entice people to buy your bonds, that's not a good thing. Rates are going to go up. So what's the yield today? The yield today is, okay, now I've lost the yield. I was on such a roll. Jeez. Okay, here we go. Where is it? My yield is at 1.30. That's my yield today, which means last week it was at 1. Last year, it was at a half a point. So you can see the trend is up a point almost over the last year. Last March, let's say last March, wasn't last February, is when COVID hit, right? COVID hit, the world ended, and now we're back in post-COVID. But when we see the vaccines are around, that's a good thing, right? People are excited about that. We think we're going to have an economy that'll open up by the end of the second quarter because we'll have 150 million people vaccinated. By the way, get a vaccine. I just got my second. That's a hooray for me. I'm not contagious. I'm on the radio, so don't worry. I'm not going to give you anything. But to me, I'm a believer in it. I remember polio. Polio was awful. So are a lot of these diseases that were out there that aren't out there anymore. So COVID will be like that if we get enough people to do the vaccine. Did you get a shot, Daryl? You know you had it, right? No, you didn't have it. Did you get a shot yet?
I'm not qualified.
Oh, that's right. You youngster.
Yeah, I mean, in June I'll be qualified.
Okay, excellent. Well, for me, I'm turned 65 last April. Oh boy, that's another thing. The depression that sets in for a man, maybe just me, at 65 is horrific, and you fight it all the time, trying to find relevancy in your life, like it's over, because everything points to getting out of the game at 65. But if you don't want to, but you do want to, I don't know. It's confusing. Anyway, I got my second vaccine shot. I think you should all get your second vaccine shots, your first vaccine shots. 53 million people have gotten their vaccines already. This is a good thing. But if we're talking about rates, we're talking about yields, we're talking about what the economy does with all this information. So the vaccines are good. Maybe we come out of the recession good. But does this spark inflation fears, especially if we're going to now give $2 trillion back to the economy through borrowed money on other kinds of debt relief, other kinds of bonds that they're going to sell? So what does this all mean? It means that we're in an uncertain time. You're going to compete. You have to compete on a rising rate market where we're not quite sure whether you're going to qualify next month at the same rate you're going to get today. So this is a do it now speech, because without doing it now, you may be forced out of the market if you're in that 1 million people that can't afford, if in fact rates rise by a quarter point. Hey, they rose by half point last week. I'm Jeff Barton. I'm your voice in the mortgage industry. Think about what I'm saying. It's good for you to be informed, and look for those vids too. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, listening to the show. We're on each and every week. Well, 5 different stations in 3 different states, from Albuquerque up to Las Vegas, Nevada, and certainly in the Inland Empire in the San Bernardino and Riverside counties, and of course up at Cape Tahoe in the Tahoe area. Really appreciate it. We're on 8 different podcasts as well as a brand new podcast coming out. Daryl, you got a list of those for me, please?
I do. It's Apple Podcast, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, of course, and Podclips.io.
Okay, all of those things. Please, if you go there, if you hear me, if you want to see, the show, go to YouTube. Jeff Barton, the Mortgage Voice. That's my YouTube channel. But say that you like it. Join. Every time you do that, it helps spread the information. Now, this information it's not easy to obtain, right? And we try to deliver it in a very easy AM format so that everybody can kind of understand what is happening. It's not simple or easy to understand the ins and outs of what goes on a daily, but we'll help you. We have great guests come on the show. One of the great guests is again back with us today, Robert Perez. He's a real estate broker in the Inland Empire. Great guy, been on the show many times, talk about what's happening in the Southern California real estate market. Robert, how are you?
I'm doing great, Jeff. Thanks a lot for having me on again.
Thank you very much for coming on the show. Okay, give us a description of today. We're at the middle of February 2021. What is happening in the real estate purchase market, first of all, and how are you doing with all the competition out there for property?
Yeah, well, that's an excellent question, and I think a lot of people are asking that. One of the difficulties that we're having is inventory. I do a lot of business in the city of Banning and Beaumont, city of Calimesa, and Yucaipa. There are 4 cities that are right next to each other, and as of this morning, the city of Banning had 30 homes listed for sale, where on the average same time last year, there was 80 homes. So, and in Beaumont, a little bit of a bigger city, there's only 45 homes that are listed for sale, which last year there were about 150. So when you put a house on the market, you're having issues with the listing agent just gets flooded with offers. Sometimes the offers are a little bit, they're just a little bit ridiculous. They're a little bit too much. But as far as that goes, you always want to try to be as prepared as possible. You have to have a great relationship with your lender and a great relationship with your real estate agent. You're making a huge purchase, so you have to make sure that these are people that you're hiring to do a good job for you.
Okay, let's delve into that a little bit. The borrower or the buyer looking for the best professional people to help them get into a house. How does that process even begin?
Well, you want to make sure that it's somebody that you have good communication with. When it comes to finding a loan officer or a lender that can help you, you want to make sure that you feel comfortable giving them all your financial information. Finding that person sometimes takes a little bit of research. It's easy to go on Google or go on Yelp and read the reviews. You can get that, or you can get somebody that's helped a family member or word of mouth from your job. That's always a good trusted. It's a good trusted friend that you can look at work that's done well, and they give you who the lender was for them, and then you can give them a shot. And when it comes to rates, there's no monopoly on rates. You know, most banks are going to offer you the same thing as other banks will offer you, depending on your credit and your income. What you want to do when it comes to lending is find somebody, like I said, that you're comfortable giving information to and that you have good communication with. That's on the lender side. On the real estate side, you want somebody that's going to be that's reputable, that's going to be able to find you the house that you're looking for. And again, it just comes down to communication. So like any business relationship, communication is the key.
Okay, now I've heard, now you tell me if I'm wrong, that local knowledge in real estate is not as important as it once was, because most borrowers or buyers can go to the internet and find anything they want about any property that's on the market or not on the market. What is your idea about product knowledge of the neighborhood, and whether that's, not as important as it used to be?
I think there's a lot of information on the internet. What's not on there that comes with knowledge of the community is if you have young children and you're looking for a great elementary school, or you're looking for
Okay.
a private school, that has something to do with it. The education for your children, you want to make sure that you find a local agent that can give you an idea, maybe somebody that even grew up in the area that can say, I went to this school, my children go to this school, and they can they can tell you where the shopping centers are. Yeah, you want to be able to be close to hospitals if that's what you're looking for.
Right.
So I think finding somebody local when it comes to real estate agent, I think that's going to be the best. You can find anybody in Southern California that can show property to you if that's, again, what you're looking for. But if you're looking for something that you want to live and you want to raise children, I think you want to find somebody local. I don't think the internet will be able to give you that.
No, that's a good point. I when you were talking about it, I was uh, thinking back about the realtor who sold me my house some 25 years ago, and that's exactly what they did. They had a personal connection with the place. Not only that, but they, I got along with them as well. So those two things really added up to a great experience for me.
It's true. It's true. And sometimes you move to neighborhoods that you know somebody in. So if you happen to have family members that are already there, they could possibly help you and tell you, this is the good side of town.
Right.
This is the great schools. This is a great public school or a great private school that you can go to. If you have that, then really any agent can help you. But if you don't have anybody that lives in that community, you have to look in to there and find the right agent that lives in the area or works out of that area that can help you best.
There's a lot of talk about discounted real estate services, and every time the market is hot like it is today, we seem to get a dozen more who jump into the market saying, hey, you don't need a realtor to do this, this, and this. I can do it for a lot cheaper. Come to me. What's your response when you hear a client or a customer talk about either giving up your real estate commission to make his experience better or competing with discount brokers?
I think you have to look at the old rule of you get what you pay for. If you
Right.
if you ask somebody to do a discounted service, then that's what you're going to get. You're going to get a discounted service. There's a lot of real estate agents out there that are willing to lower their fees, but at the same time, everybody has bills to pay. So you
Mhm.
want to hire somebody that's going to provide the best service and make sure that they're getting paid and compensated for it. If you don't feel that you're getting what you deserve, then that's not the agent for you, and you should probably find somebody that's going to do that. I think a discounted service is not a great idea just for that reason. You want somebody that's going to fight for you and feel comfortable going, finding the location and getting you what you're looking for.
Do you find the marketplace right now is a fair marketplace, i.e. that there's not a lot of insider or backdoor deals that don't hit the real estate market? Or do you think that it's still controlled in a large measure by deals that don't hit the MLS?
Oh, that is a real good question, and I think that comes down to location. Where if it's a hot zip code and properties are moving fast, or it's an area where there's not a lot of properties that have come up for sale, you may encounter that properties that don't hit the market, uh, buyers that are already set and ready to go with some agents in the area, and they tell them as soon as a property comes up on the market in these areas, I want to buy. You just put me right in there. So that's where some of the listing agents have an advantage, where they may have a list of people that want to buy there. That's not easy to find, but those are, like, again, in the zip codes where the market is moving very fast. There are other zip codes that don't move quite as quickly, although the market right now for
Right.
sellers is amazing. I
Right.
think if you put a house on the market right now, you should expect several offers if you price it correctly. So I don't think that I don't think that there's a lot of hidden tools that you can use. But again, it always comes down to communication. Get out there and start shopping. Get out there and find the right agent and lender for you, and let them do their job and let them perform for you.
Hey, Robert, could you tell people how to get in touch with you? You're such a great agent, broker. Let people know how they can get in touch with you and work with you.
I appreciate that. My name is Robert Perez. I'm with Evernest Realty based out of Pasadena. My phone number is 951 area code 538-4148. Once again, it's 951-538-4148.
Robert, thank you very, very much for coming on the show, and we look forward to talking to you again in the future.
Thanks a lot for having me, Jeff. I appreciate it. Talk to you guys soon.
Talk to you soon. That's Robert Perez, real estate broker. I'm Jeff Barton, your voice in the mortgage industry. Be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show each and every week. We bring some great guests. We bring some information. Mostly, we try to help you because, it's a difficult market right now. It's a difficult market for many, many reasons. Obviously, the main reason is that you can't get in and see houses. There aren't enough houses to see. The cost of housing is going up. The cost of construction is going up. But rates are still pretty low. One of the main things about all of this is how your credit score affects how much you pay. I mean, let's face it, if you're going to lend somebody money, you want to know what they borrowed it for in the past, how they did it repaying it. And so in order to do that, we have to talk about credit. Talked about it a little bit earlier in the show, and I really beat up on people who just are relying upon a certain strategy. But to really get to the heart of it, we brought an expert to the show today, a guy that's been on the show before, Robert Childs from debtandcreditguys.com. They also have a podcast. I'll let him talk about it a little bit. But welcome him to the show. Robert, how are you?
Not bad, Jeff. Thank you. Yeah, very doing well.
Excellent. And thanks for coming on the show. Okay, there are a number of things you do with what you do. Could you explain that to the audience and give us a little overview of the different services that you offer?
Definitely. Yeah. On our website, debtandcreditguys.com, it's a body of, mostly credit repair, credit restoration, debt settlement, if someone needs a collection debt settled for, let's say, debt to income purposes, and to improve their FICO score. Also, a debt shredder, which actually shreds interest on mortgages, current on-time credit card balances, student loans, car loans, things like that, and a legal service. But the foremost important service is the credit restoration, because we found out, Jeff, that we're looking at people's reports. You probably look at 500 or 600 credit reports on a weekly basis and find that
Right.
90% of them could utilize regular credit restoration for the purpose of deletion of some of these outdated, older collection accounts.
What is the main thing that causes people to lose score? I mean, score is what risk is what rate is. And if you're borrowing money, that's about the most important thing to you. What is the rate? So if you have certain things on your credit report and you take them off, what kind of bump can you see? And what are some of the common things you see on credit report that can be removed?
Collection accounts with an FCRA violation on it, stands for Fair Credit Reporting Act violation. That could be usually either someone owes $10,000 on a credit card account or a medical bill account, and they know it's their fault. There's a good chance it could be removed, not a 100% chance, but a good chance due to the fact that there might be an error that the credit bureau made filing that on the report. That's number one that can help someone boost up their credit scores quite quickly. The second one, we take a look at current on-time credit card balances. Credit cards are 30% of your score, or they're responsible for up to 250 points of your 700 points. So if someone's maxed out, guess what? Their scores could be lowered by 150, 175 points, sometimes 200 points in that example. And also people who close credit card accounts can also have an adverse effect on their credit scores. So those are the three really top things that we see why someone's scores would drop or why they would go up by deletion or, of course, elimination or reduction of credit card balances.
Okay, so a client comes to you and you present them with some of these options. What are some of the specific things you tell a client who has a balance that's too high? Do you say pay it down, or do you give them a way to do that? Is there a plan by which you provide them monthly sort of incentives to do that? Whether it's lowering their credit score will get you this, or this is how you lower it. What do you tell these clients?
Well, the first thing we do is take a look at is the positive accounts. How can you make positive more positive? In other words, how can we give them a trampoline effect to improve their FICO score? Then we address all the negative issues. Someone may say, "Hey, I owe $2,000 on this collection account. I paid that for a lesser amount a year ago. Here's proof of." So there's a variation that can be done through rapid rescoring. But the most important thing is if someone says, "Well, I want to buy a home. I'm going to put 10, 20% down payment, but they're maxed out on 3 credit cards, let's say, for example, $20,000. I'd say to them, "Client, pay down half of your cards or 75% of your cards." They say, "Well, I got to save my money for my down payment." Well, not knowing that if you improve your FICO score 100 points, it might require a much of a less down payment, like FHA financing requires, 3, 4, 5%. So you might even have it in your pocket after that. So it would be a trade-off. You borrow money from mom and dad. Anything to do to get that credit card debt under control to improve that FICO score.
Do you know the ratio of what it means to the credit card companies or to the credit bureaus? Like, is it 50% and then it affects it positively, or is it 60%, 40%, whereby it doesn't negatively affect you on the amount of money you have already on your credit cards?
The number is approximately 30% or more. Let's say 31% or more. So if someone had a 40% debt shield, so in other words, let's say they had a couple of credit cards with a total of 10,000 limits and they had $5,000 in debt, that's a 50% availability. So if they brought that debt down to, let's say, 2,500 in that example, they would increase their availability to 75%. So that would be positively reflected the month after improving in the FICO. So the answer to the question, 30% is roughly where it starts having a negative impact, slight downward effect in your scores. But keep in mind, even if someone may charge up that credit card that they can pay it off on a monthly basis, like a few Americans do, then that number doesn't really matter if they do pay it off on a monthly basis, even if they max out the credit card.
Are they looking more at revolving credit versus the frozen credit score or frozen credit report that they see? How is credit viewed nowadays? One, when you're helping people, and two, when you think about getting a loan, what is the lender or the person lending you the money, what are they looking at?
Well, certainly if you're buying a car or a house, the lending options might be like buying a car might be a little bit easier because it's a secured item by the pink slip on the car, the title on the car. Credit cards, on the hand, are completely unsecured, so it's a little bit of a risk. I had a client the other day. He said, "I bought a car for $45,000. I got approved quickly, but I applied for a $2,000 limit credit card. I got declined." Well, one's secured, the other one's not secured based on your current debt risk and credit risk. See, so I tell people, never close accounts, especially old credit cards. I don't care if it's a Macy's or a Nordstrom's. Don't close it. That makes up 15%. That's 15% of your score. Credit cards are 30%, and installment loans are 10%. See, so overall, that's almost 3/4 of the pie, if not more. And if someone has maxed out credit cards, or I had a guy one time, Jeff, he had a mortgage and 2 car loans. He couldn't get above a 645 bill, nothing negative. I said, go out and get a couple of credit cards. He did that on a secured card basis. His score jumped 125 points. See, so it's a big difference between looking at, and when we take a look at a client's credit report, that's part of our free analysis. We'll give them suggestions right now. Because in some cases, a lender may say, I need a 1 or 2 year clean history. Any recent lates, especially on a car loan or a recent mortgage, I don't care if you have a 720 FICO, you might be declined. But so it depends on lender to lender, underwriter by underwriter. Some look at income and credit scores. Some look at 2-year history of being clean, 1 year clean history. Depends on the lender. But that could be addressed while I was talking to my client over the free consultation.
Excellent. Well, that brings us almost to the end of the interview, but I want to have people be able to get in touch with you. Could you let them know both your website, maybe your podcast, a telephone number, some way that they can use you, talk to you about their credit scores and what's going on?
Yeah, my phone number, I'll say it twice, is area code 949-371-8885. Again, 949-371-8885. My website is DEBT, with an A-N-D, DEBT, D-E-B-T, A-N-D, credit guys with an S on the end.com, debtandcreditguys.com. And I recommend someone, if they wanted a free analysis, run a copy of the credit report from Credit Karma or a lender like yourself, or annualcreditreport.com, and email to me. And please let me know on an email that you heard me on the show, to Robert at debtandcreditguys.com. And mention the show in the subject line, call them back with a free consultation of that report.
Robert, thanks very much for coming on the show once again. It's always educational, and I really appreciate it. Thank you. Thank you.
Guys, have a great day. Appreciate it. Bye-bye.
Thank you, too. It's Robert Charles from debtandcreditguys.com. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, listening to the show each and every week. We bring information about real estate and mortgages. Now, we've had a pretty interesting week. Mortgage rates have jumped, and when I mean jump, I mean half a point. And for you out there competing, you know, every quarter or half point it goes up, it means you can borrow less. So that makes you less competitive in a marketplace where you need to be competitive. And so to answer some of the questions for us, we brought Richard Green from New Mexico Mortgage Company down in Albuquerque, once again, back to the show to describe what's going on down there and how we're solving the rate problem right now. Richard, how are you?
I'm doing great. How are you doing, Jeff?
I'm doing great as well. Thank you very much for coming on. So tell us about what's happening there mortgage-wise and how the rates are affecting your borrowers.
So, as mentioned, there was a jump. It took some people by surprise. We're fortunate that we have some indicators that kind of knew it was coming, and we locked as many loans as possible.
Good.
The half percentage jump. Our market, we're median house price 250 to 350. We're fortunate that 0.5% doesn't necessarily kill a deal, and so we're fortunate with our house prices. The median house price 250 to 325. It hurts, but it doesn't hurt as in other major large cities where a starter house is 500,000.
Right.
So here are the starter homes that are 200,000. Yeah.
Okay. Now I know that you. What's that?
We try at New Mexico Mortgage try to manage expectations, and it hasn't killed any deals. It hasn't hurt. It stinks, but fortunately, the amount of difference we're able to just move forward and get the new homeowner in that house, which is ultimately what we want to do.
What are the criteria for most of the loans you're doing? Are they straightforward 80-20, meaning 80% to 20% down, or are you getting into FHA loans? What is your product mix currently over at New Mexico Mortgage?
In the Albuquerque market, it is extremely. We utilize lower down payment programs, so absolutely a good bulk of FHA, 3.5% down, 3% down conventional home ready type conventional programs. Albuquerque has a good many veterans, as probably other towns. But we have an Air Force base here, and we have some other benefits. There's a VA hospital in Albuquerque. And so we do a good handful of DA zero down. And then even just outside of Albuquerque, just the next county over and the next county south, and even a little bit north of us, we can do USDA zero down. So we see a lot of higher loan to value loans, definitely as a majority.
Have you seen the house appreciation there, like we see throughout most of the country? And couple that with your employment being, yeah, right.
We've had a great spike. I don't know the percentage off the top of my head, but just in general, yes, we've had more appreciation probably in the last year than we've literally had in, I don't want to say 10 years, but just that's kind of an off-the-cuff comment. But we've had great appreciation. I've always joked, Albuquerque's been the fable, the story, the tortoise and the hare. Albuquerque's just the tortoise. We're slow and steady, where other markets go up and go down, where we're always we get 1% appreciation a year, 2% appreciation a year, to where it's just slow and steady, to where now we easily could have had 10 to 15% appreciation. Again, off the cuff, overnight, but again, it's been in the last year. So it's been really, and it's been a little bit of a buying frenzy for the Albuquerque market. You know, our supply, and 2 years ago, we had more of the supply than we knew what to do with. And then, of course, COVID hit, all the supply bottomed out, but the demand equaled it out. And so there is still great demand, especially with low interest rates and limited supply. So for the first time in a long time, there's 1 day on the market, 2 days on the market, multiple offers. And that's, again, if it's a nice house, priced well, under $275, it literally has been selling in a day.
Wow. That's very similar to what goes on in a lot of the country.
Okay. So that's what's been going on here.
Okay, the employment there is also pretty strong, isn't it? I don't think you lost as many jobs as they have in most major cities. You attribute that to what in general? Is that government jobs in your area?
Well, government jobs.
Yeah.
So Albuquerque in general has I think the largest, some of the top 5 employers in Albuquerque, believe it or not, is the city of Albuquerque is probably a top 5 employer.
Right.
The University of New Mexico in Albuquerque is a top 5 employee. The national, so in Albuquerque, we have Kirtland Air Force Base. And so we have a very big Air Force base. We have one of the national laboratories. It's called Sandia National Laboratory. In New Mexico, we have 2 of the 3 national labs. There's one in California, and then there's 2 Los Alamos National Labs in Los Alamos, New Mexico, and Sandia National Labs on Kirtland Air Force Base, which is huge funded. And then even the Air Force, we have an Air Force Research Laboratory Center at Kirtland Air Force Base too. And that probably rounds out the top 5 employers in the state.
Right.
We don't have massive manufacturing or massive, and so we have a lot of government, and we were hurt in tourism. New Mexico, believe it or not, is a tourism state, be it Santa Fe, the capital, is always a destination for tourism. Even Albuquerque, over the years, would have great convention numbers in tourism, and the balloon fiesta is a big draw. So I would say that really helped. The government workers were retaining their jobs in one fashion or another. So it really has helped.
No, I think that's why you see a slow, steady gain, but not necessarily leaps and bounds, just because the employment is strong. People tend to probably stay in the homes that they buy longer than they do in some other areas, may not get the same kind of turnover. What is the mix between your refis? Are you seeing a lot of refis, or is it mostly purchase?
Well, no. Well, I mean, since probably March of last year, we've been on a refinance festival. I mean, there's been a lot of opportunity. Even folks that were at So between a 4.5%, and then they have some appreciation, so they're getting out of mortgage insurance. We haven't done a ton of cash out. They're not surprising, but it's a lot of folks are just simply taking advantage of the rate. Maybe if they're in a 30, not quite going into a 15-year, but maybe going into a 20-year just to not start over again. And so it really has been a big refi. It's been, I don't know, in March it was probably 70-30, and then kind of here a couple months ago it kind of evened out at 50-50, 50 purchase, 50 refis, and now things have relaxed a little bit, but the market is still extremely healthy, and refis are still doing really well, and same with the purchase business.
Richard, hey, we're up against the clock right now. Could you shout out a way by which people can get a hold of you and reach you? That'd be great.
Absolutely. Thank you, guys. So it's Richard Green with an extra E on the end, Greene. And I'm at New Mexico Mortgage, and I'm at 505-292-3200. And you can also visit us on the web at nmmortgagecompany.com. So NM, the abbreviation for New Mexico, Nancy Mary, nmmortgagecompany.com. And love to visit, love to talk about the market. So thank you.
Richard, thank you very much for coming on the show. I do appreciate it. Yeah, we'll talk to you soon. And I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show each and every week. Thanks for tuning in this week. Hey, if you like the show, go to the radio station. We have just a number of different radio stations that we're on. I just want to give a shout out to KCAA, KMET, KTHO, KMIN, and KSHP, and that's down in Albuquerque, New Mexico. Is that right, Daryl? Is that the one down there?
K-Shop is in Las Vegas.
Oh, K-Shop, right, in Vegas. Okay, sorry. So all these affiliates that we have that do the show, bring the show to you, are, it's kind of a funny show because what we do only affects people if they're really interested in either buying or refining a house, right? If you're not, you're gone. But if you are, this is the type of show that's really for you. In all of those markets, real estate market is hot. Now, what do I mean by hot? Prices are going up, and there are multiple offers on each and every home that's being offered for sale. Now, is that good? Maybe not. But it does make this type of information more valuable. So if you're out there and you have friends, have somebody that wants to hear about it, you can find us on all of these radio stations: Albuquerque, Las Vegas, in Southern California, a couple stations in the Inland Empire, San Bernardino, Riverside counties, and up in Lake Tahoe area in California and Nevada. And as I said, if you have a friend, you have a family member, somebody that needs this information, this is where to go. We're also on 8 major podcasts, plus a new podcast that's out there. Daryl, you want to give us a rundown of those, please?
Yeah, we're on Apple Podcasts, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, and soon to come to podclip.io.
Okay, podclip.io has a lot of great information. Take your time podcast service that will walk you through a number of different things in the financial area, and that's the one I was interested in. But they have a lot of things on there, so that's coming soon. All of these things, if you go to them and listen to me, say that you like it. Become a subscriber, become a member. The information is always at your fingertips. You can look at it, hear it, see it. If you want to see it more frequently, go to YouTube. Our YouTube channel is Jeff Barton, the Mortgage Voice. We have our weekly, everyday show on LinkedIn and Facebook that's on there. And we have our daily show, LinkedIn and Facebook, and our weekly show, which is on the radio stations. Thanks for tuning in. End of commercial. Okay, so a couple things about loans themselves today. What are some of the things pushing the loan industry? We talked in an earlier segment about the rising interest rates, why that is, and whether that's a good thing, whether it's not a good thing, and what you can do about it, and how you're being squeezed if you're a marginal borrower. marginal borrowers, whatever that means to you. To us, it means somebody who may be challenged financially, or in this particular segment, let's talk about credit. There have been rumors, and we have seen some change in how credit is evaluated. We've had also people in the federal government during the Trump administration. A couple of things they did were pretty good, actually. One of the things was to try to change the credit profile so that Fannie Mae and Freddie Mac, the companies that purchased most loans, conventional loans, changes the way they look at credit. One of the things that was changed was, instead of looking at a snapshot, and everybody talks about, okay, what's your credit score? That's really a snapshot of who you are right now, whether it's TransUnion, Hesperia, or Equifax, the three credit reporting bureaus. There has been a call to change that, to go to a government system. Now, when we say government system, what do we really mean? We mean that Freddie Mac and Fannie Mae come up with their own, and they're quasi-government, and hopefully soon to be, at least in the next, dare we say, the next 3 to 4 years. It may even be longer, but they're inching towards that. And we talked about it in previous weeks about how the sweep from the Treasury of taking all the profits of those two companies and putting them in the Treasury, that ended. And one of the issues and problems that Biden's going to have in his particular administration, and Yellen in her particular administration of the Treasury Department, will be the fact that that money is not regular. It's not coming in. We found out Freddie Mac made $7.2 billion and over $4 billion for Fannie Mae. So that's $11 billion that doesn't get swept into Treasury, and that's a bit of an issue. That money gets saved in both of those companies in order to match or meet the, I think it's $165 billion minimum that they're looking for with which to be able to exit conservatorship. Okay, so be that as it may, those entities are looking to get into the credit game, i.e., what is a profile of somebody we want to lend to or buy their loans from? That's really what it is. The lenders, the people that sell to Fannie Mae and Freddie Mac, your regular big box banks, your Wells Fargo, your Bank of America, your Citibank, your Chase Manhattan. These companies look to the credit score as part of their mix of credit risk. I mean, obviously, if you have a 620 FICO score versus a 750 FICO score, you're going to be more risky to people who look at the snapshot. So if we got rid of that and we started to look at how you've been paying your bills over the last year, how about 18 months? Well, that's what it is. It's about 18 months that they look now in a revolving credit situation. This is the model that they've been more comfortable with. Reason being is that let's say you had a bankruptcy, let's say you had a foreclosure. Now, this was obviously going back to 2008. It takes about 10 years for that stuff to fall off your credit score. Well, we're way past 10 years now, right? We're at 2021. Which is a good 11 years past where the crash happened. So a lot of those people who had credit issues should have fallen off, but if they haven't, looking at the revolving credit score is the best way to evaluate you as a borrower. Most banks are not doing that. I can tell you most mortgage brokers aren't doing it, because when we submit to banks, I say we because Malibu Funding, the company that I actually work for, they're a mortgage broker in 13 different states, NMLS 79620, and they're the type of people who will look at the credit score, the frozen snapshot credit score, because that's what's called for in most programs when they're looking to lend you money. This is a long way to go to tell you that whatever you can do to get your credit score to a point where it is above 700, it's going to help you. It's going to help you in two things. One, it's going to help you in the rate. Credit score equals rate, or at least that's what most programs will identify as the key factor when we're factoring in what rate to charge you. So if you've got a 620 FICO score, everything else is great, you're going to get a different rate than someone with a 750 FICO score. Why? Because the credit risk is different. Because the snapshot tells us this is who you are. Now, what I would like to see, what I think we're trying to get to, but which is a monumental task, because we need to have the investors, the banks, the government regulators in a slow procession towards trying to reevaluate you as the borrower. Look at how have you been doing lately? And what's lately? 18 months, maybe 24 months. The credit analysis by which you get evaluated will be the most determining factor as to rate. It's not how much you have down. It's not the loan to value. It's not the kind of money you make. You could be the greatest earner in the world, show deposits every month in your bank and a 20-year track record at the company you have. But if you show in that snapshot, you are late on your bills, or you have charge-offs. You know what a charge-off is? The company you owed money to finally just threw up their hands and gave up. That's a charge-off. But it's on your credit report. All of these things mean a big deal. Now, in an earlier segment, we talked about rates go up a quarter point, million people can't get a loan. They used to be able to get a loan when it was a quarter point less. Well, you look at that in terms of your particular situation. If your particular situation and the rate goes up by a quarter point, can you afford that property? And in this competitive environment, in this competitive market, believe me, you want to have the highest credit score so that you can get the lowest rate, because the lowest rate means that what you do have as your profile as a borrower is the ability to borrow more money. So let's say that the bid comes in and everybody is stuck at $280,000 for this house, 5 bidders, and the realtor says, okay, give us your last and best offer. We've all heard that in the industry. You want to make sure that you can borrow as much as you can borrow if you want to buy that house. Maybe your dream house, maybe the house that you want to build equity in so that you can pass that long-term wealth on to your family members. We all know that everybody who has a home is more likely to be able to get to long-term wealth than people who rent. Your home is your number one asset. It tends to be, for older Americans, completely paid off. As I said, 50% of Americans have paid off their mortgages. Anyway, I appreciate you listening. This has been a great show, and we will see you soon next week. And I'm Jeff Barton, your voice in the mortgage industry. We'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.